Hi there, Phil. Yes, well, we have been following Wall Street's reaction to the Fed. They've been following it very closely, and Wall Street really chose to see the Fed remarks in a more positive light. That vagueness a rate hike sort of seen as a no news is good news situation. Now, it was a choppy session. All three indices did manage to finish in the green. The U.S. Central Bank's remarks that the U.S. economy is strong enough to weather an interest rate hike did seem to encourage investors somewhat. The Dow, the S&P 500, and the NASDAQ all gaining around 0.2%. Now, the dollar fell more than 0.5%. It's now at around 123 yen, and the euro is now around $1.13. And for more reaction to the Fed's decision, I'm joined by Nicholas Economides. He's the economics professor at the Leonard N School of Business. Very good to see you, Nicholas. Thanks for joining us. All right, so no major surprise today, right?
No surprise, that's right. I mean, things are going smoothly, and we expect some rate hikes over the year, but interest rates are remaining low.
Nicholas, here's what's interesting. Half of the Fed said we're going to have 2 interest rate hikes by the end of this year. That was the sentiment that came out of the meeting today. Now, keep in mind, 6 months ago, we had half of the Fed saying that there will be at least 4, perhaps even 6 or 7 interest rate hikes in 2015. Now, as an outsider, this is making me feel like, does the Fed actually know what is going on with the economy?
I think they do, but they have been very much on the lenient side, keeping the interest rates very low. Now, this is not a policy without dangers, because very cheap money creates speculation in commodities and other markets.
And you think they're being too lenient?
I think they are. I think they should really increase, given what they say is their target inflation rates, they should try to catch up with it as soon as possible.
So you see a September rate hike?
I do.
Well, here's the interesting thing. We've got the IMF telling Janet Yellen, no, the U.S. is in no position globally to increase rate hikes. As we said, the overwhelming majority of members of the Fed do want 2 rate hikes by the end of this year. But this is against the trend that we're seeing from other central banks in the world. The ECB has stimulus. The People's Bank of China is increasing stimulus. The Bank of Japan is increasing stimulus. So can the Fed go against the trend of so many of the other big central banks in the world?
Well, yes, because after all, every country does what is best for its own economy. So it's not surprising that different economies are growing at different rates, and therefore the central banks in different parts of the world follow different policies.
But won't that jeopardize the U.S. in the global scheme of things? I mean, it is a global economy, and that would have an impact if you're going against the trend of every other central bank.
Well, that's not really I don't think there will be a jeopardy there. I think there will be changes in the exchange rates.
Well, what about the dollar? And that's been a big deal. I mean, a lot of these multinational companies have been really hurt by the strong dollar, especially with their overseas sales. Surely a Fed interest rate hike is going to strengthen the dollar even further. We saw it drop a little today because of the decision to not raise the rate. So can the U.S. handle an even stronger dollar?
Well, I don't think you can do everything. You can do some things. The policy is not going to satisfy everything. So we will have a strong dollar. Some people are going to get hurt. But on the other hand, we want to make sure that there is reasonable macroeconomic policy in the years ahead.
What about the strength of the economy? The economy has fallen well short of that 3% growth expectations. GDP contracting 0.7% in the first quarter. According to the Atlanta Fed, we're not going to see much more than 1.9 for the second quarter. Does the economy have the juice to sustain it? Is it still too fragile?
It's very hard to say. It looks pretty good, but it's not perfect. And we have seen a significant weakness in wages. Wages have not increased much, which shows certain weaknesses in the labor market as well.
Well, you were saying, you know what, keeping rates low is a bad thing for commodities markets. And, you know, some analysts are saying that what could be an unforeseen danger is should the Fed keep things as is, and then we're hit by some kind of black swan event, some catastrophe that no one's banking on, and the economy stalls, that the Fed then has no weapons, no power to do anything to recharge it. What is your take on that?
I wouldn't worry about that too much. I mean, we cannot easily predict this black swan event.
Well, hence it's a black swan.
Yeah,
but
exactly.
Should it happen, what is the Fed going to do? It's got nothing in its arsenal.
Well, this is like saying what would happen if Los Angeles falls into the sea, which we know it will happen at some point in time.
But we hope not.
But hopefully not in our lifetime. So there isn't too much you can do about that, but I wouldn't worry about that so much. Not having an extra
one thing
weapon.
to worry about is a Grexit. Greek exiting the euro. What impact is that going to have on the Fed?
Well, it's going to have a terrible impact on Greece. Greece is going to be demolished. It will be a total catastrophe for Greece. It will have some effect, but a limited effect on weak European countries such as Portugal, Spain, Italy. It's unlikely it will have a significant effect anywhere else, and it's unlikely it's going to have an effect in the United States.
It won't affect the way the Fed makes its decision if it's forced out of the euro?
I don't think so. I think Janet Yellen was extremely cautious, saying we should look into that, but I doubt if it's going to make any difference.
And very quickly, you say September rate hike.
Yes.
All right. Thank you so much, Nicholas Economides, economics professor at the Leonard N. Stern School of Business.